Hey everyone, Barry Brooksby here. There's a recent story about IUL, Index Universal Life Insurance, misleading numbers and practices. And what's interesting is this isn't just a one-off lawsuit. There are quite a few lawsuits out there regarding Index Universal Life Insurance. This recent lawsuit is with NASCAR's Kyle Busch. He's suing the insurer Pacific Life for $8.5 million over alleged deceptive practices. You can Google this and see some of the stories here. If you have an indexed universal life policy, chances are you're going to deal with some problems. We're going to talk about those problems and how to potentially fix the problems. The first problem that most IULs have are surrender charges. And these surrender charges can last 10, 12, 15 years. We are going to look at real life IUL examples. Here's the first IUL company we'll look at to show surrender charges. When the $12,000 premium goes in, what's available in first year cash value is zero. There is $8,300 of accumulation value, but because of surrender charges, there's no money available. And this policy has 12 years of surrender charges. In this next IUL example, we see that when the $140,000 first year premium goes in, the net surrender value is $68,000. Accumulated value is $123,000, but far less of the premium is available in cash value. This policy has 10 years of surrender charges. In our next IUL example, when the $6,000 a year premium goes in, the cash surrender value is zero. High surrender charges. This particular policy has 15 years of surrender charges. In our next example, when the $84,000 first year premium goes in, $0 of that is available because of surrender charges. And this policy has 10 years of surrender charges. In this IUL example, when the $50,000 premium goes in year one, cash value because of surrender charges is only $26,000. In our last example, when the $12,000 a year premium goes into this IUL, the surrender value is zero for year one. And this policy has 15 years of surrender charges. I recommend whole life insurance because whole life insurance does not have surrender charges. Another problem with index universal life insurance is increasing costs. You see, IUL is built on the chassis of annual renewable term insurance. The older you get, the higher the cost of the insurance. So you've got to look at your policy to see, what do the guarantees show? Is your policy going to lapse after you've put all this money into it? Increasing insurance costs can erode your cash value. If you're not paying that extra higher premium, the insurance company will take that money from your cash value to make those higher premium payments. The way we see those increasing costs in IUL is in the guaranteed scenario. Always look at your guaranteed scenario. The reason, the guaranteed scenario shows the impact of increasing insurance costs and other costs that go up as you get older. Notice on this illustration that the $12,000 is funded for 15 years, and starting year 16, there's no more premium going into the policy. At this point, the surrender charges are gone, and the high point of cash value is $114,000. But why does the cash value begin to erode in year 16 and eventually go to zero after age 74? It's because of increasing insurance costs. We also see here in the illustration policy charges. Notice they increase every year as you get older. Those increasing costs will always be with you. In our next IUL example, here we see guaranteed interest. The high point of cash value is $1,002,000. We see eroding cash value, and eventually at age 59, there's a lapse. Why? Because of those increasing costs. In this IUL example, the guaranteed assumptions show how the increasing costs erode cash value. We see the high point, $10,700, age 71, cash and death benefit are eroded to zero. And specifically in the illustration, rider charges, cost of insurance, increasing over time. Before you purchase an IUL, look at the guaranteed values, look at the costs in the illustration. And if the illustration doesn't show the costs, ask for the pages that show the costs. Whole life insurance does not have increasing costs. Another problem is unrealistic returns. And this is what Kyle Busch was seeing in his index universal life insurance policy. The illustration is showing projections, but in reality, those projections are not being met. See, an IUL is only showing the positive returns of the market. It never takes into account the losing years. So these returns are unrealistic because it shows consistent market performance and you making money every year in an IUL, but that is not how IUL works. In this IUL example, they're showing an earnings rate of 7.08% every year, as if you're going to earn that year in and year out without ever having a losing year. That's not how the market works. The market doesn't earn 7.08% every single year. There's volatility. We know some years there are going to be losses, some years it will be higher than 7%. The problem with the IUL illustrations that we're looking at today is none of them take into consideration in the non-guaranteed values any market volatility, and that's completely unrealistic. The market is going to lose money, and the illustrations do not show that in the non-guaranteed values. They only show you earning 7.08% for the rest of your life, which is impossible, and it's completely unrealistic. So if we take that 7.08% return that's used in the current scenario, this policy was funded at $12,000 a year for 15 years. $180,000 went in, no more premiums thereafter. We're going to look at two numbers. We're going to look at the total cash value in year 15 and calculate what rate of return that is. Here's our 15 years, 7.08%, $12,000 a year. There should be $324,000 in the policy, but what we see is $227,000. Let's run this out to age 90. 1.6 million in total cash value. That's 45 years. And in year 16, there was no more premium going into the policy. What should be available in cash value? $2,529,000. But what do we see in the illustration? $1,607,000. If we do the math, $2,529,000 minus $1,607,000, what happened to $918,000? Where did it go? If the illustration shows 7.08%, where's the rest of the money? And why doesn't the IUL perform the way that it's illustrated? In our next IUL example, the current interest rate shown is 6.64%. And notice, 100% of this is going to the S&P 500 index. In 19 years of funding, $84,750, cash value is $2.69 million. When we do the math on this, using the calculation, 19 years, 6.64%, cash value, $3.25 million is what should be in the policy. The difference, $557,000. Again, where did that money go? We have to look at increasing insurance costs, increasing policy charges, and unrealistic returns. The IUL is not going to earn 6.64% or 7% or 8% every single year. There is going to be market volatility. Even this number we see of 2.699 million isn't accurate. Why? Because the market doesn't perform positively every single year. But in the IUL illustrations, that's what they assume, that you are going to make money every single year, and that isn't true. Some of you might be thinking, well, Barry, 6.64% is an average rate of return. An average rate of return is meaningless. I'm going to get to that in a minute. What does 2.69 million actually translate to? I come back to the calculator and I pop in 4.94%. There's our 2.69 million. So the illustrated non-guaranteed value is really 4.94%. But even this is misleading. Why? Because the policy is not going to earn 4.94% every single year. For those of you saying, well, Barry, it is an average rate of return. Some years are going to be higher, some years are going to be lower. Let me share with you what average really means. I've titled this calculator Average versus Actual. They put in $50,000 and in year one, they have 100% return. They turn their $50,000 into $100,000. But in year two, they lose 50%. They're back down to the same $50,000 they started with. Year three, they have another stellar year. They earn 100% return, back to the 100. And finally, in year four, they lose another 50%. Now, what's so interesting about this is their financial advisor or their quarterly or annual statement would show them that they earned an average rate of return of 25%. But their actual rate of return is zero. 4 years have gone by. They have the same 50,000 they started with. The math shows an average rate of return of 25%. But we all know, looking at the numbers, when you put real money into earnings, the actual return here is zero. An average return is meaningless. You have to put real money into it. And there's a name for this. It's called sequence of returns. You have to factor in the sequence of returns, that when you lose 50%, it takes much more than 50% just to get back to even. If you lose 50% in 1 year, you can't just have a 50% return in year two to get back to even. That only puts you at 37,500. You have to have 100% return just to get your money back. Average rates of return are meaningless. You must look at actual returns. And in an IUL, there are multiple problems with these unrealistic returns. Not only do the IULs not perform as illustrated, but even the illustrated values are unrealistic because the market does not make money every single year. Whole life insurance does not have unrealistic returns. It's based on a chassis that's guaranteed to make money every year, no matter how old you are, no matter what's happening in the stock market or the economy. I've always supported permanent dividend-paying whole life insurance for cash value growth and the infinite banking concept, not indexed universal life insurance. So to learn more and look at your own numbers, you can reach out to me. I would love the opportunity to help you fix IUL problems and really show you a better alternative where you can have guarantees, peace of mind, predictability in your portfolio, and not to worry about an IUL blowing up in the future and you losing money that you've put into it.